In 1973, an oil embargo suddenly took 5 million barrels a day off the global market. That sudden deficit led to rationing and national speed limits. Gas was only available on certain days, and lines for gasoline wrapped around blocks. Fast forward to today. The current closure in the Strait of Hormuz has taken roughly 9 million barrels of oil a day off the market. In pure oil supply, what's happening right now is a larger disruption than the 1970s crisis. Yet the price response today is smaller. In the 1970s, oil prices quadrupled. Right now, despite a larger shortage, we haven't seen an increase near that magnitude. The sheer scale of modern oil consumption explains some of this price resistance, but we also have to account for the monetary policy environment. In the 1970s, the oil embargo was only half of the story. The supply shock hit at the exact same time the United States was changing the way it managed money. In 1971, the United States ended the gold standard. For the first time, the government was no longer constrained by a physical limit on how much money it could print. The money supply immediately accelerated, shifting from a steady trajectory to a much faster pace of growth throughout the rest of that decade. We are seeing the exact same pattern today. After years of predictable expansion, the money supply spiked in 2020 and is continuing to grow way above its historical trend. This has pushed the consumer price index onto a new, higher trend. Total price levels are increasing faster than they were before 2020, and that rate is not slowing down. The 1970s and the 2020s share the same backdrop, a massive physical supply shock occurring right alongside a rapid increase in the growth of the money supply. And even if the Strait of Hormuz were to completely open today, the physical side of this crisis would not return to normal immediately. Over 34,000 shipping routes are diverted. Containers take weeks or even months to reach destinations that once took only a few days. These diversions are overwhelming other hubs. The port of Khor Fakkan has been locked at 100% congestion for over 10 days, with average delays peaking at 9 times their pre-crisis levels. Traffic is also being deterred by the threat of naval mines. No shipping company wants to be the one that accidentally hits a stray mine that for the foreseeable future. The result is a market where a massive expansion of the money supply is chasing an actively choking supply of physical global goods. This pressure travels quickly down the supply chain. As fuel becomes more expensive, the cost of producing fertilizer spikes along with it. If farmers can no longer afford fertilizer and may be forced to produce less food, those who do maintain production have to pass those higher input costs directly to the consumer. Between the decrease in total supply and the increase in production costs, food prices are set to remain much higher across the board. This is no longer a theoretical market issue. It is a prolonged reality that will be felt at the grocery store for the foreseeable future. These costs will likely trigger recessions across Europe and Asia, as many countries simply cannot handle these sustained price increases. The United States, however, is in a much stronger position. Since the start of the conflict, U.S. stock markets have been drastically outperforming emerging markets. You can see the divergence in the data. The S&P 500 is up almost 6%, while international index funds like the VX-US are down 0.5% over the same period. While many will feel the pain of this crisis, specific sectors are positioned to profit from these disruptions, no matter how long it takes to resolve the logistical bottlenecks. By understanding how these twin engines of inflation interact and tracking the geographic data, you can protect your portfolio. I'm hosting a free event this week to show you my specific strategy for navigating this environment. You can register at the link below. Right now, the S&P 500 and the Nasdaq are posting all-time highs. If you only look at the stock market, the economy appears to be running smoothly. But if you look at the Persian Gulf, you will find thousands of cargo ships stranded in the water. This chart tracks the number of vessels passing through the Strait of Hormuz. You can see the high historical averages early on, but starting in January, the numbers drop. Through March and April, they are practically non-existent. The strait is currently operating at roughly 5% of its normal capacity. According to the International Energy Agency, the closure of this single waterway is creating the largest oil supply shock in history. The sheer volume of trapped resources surpasses the physical disruptions of 2020 and even the notorious fuel shortages of the 1970s. Before this bottleneck, oil tankers carried about 15 million barrels of crude and refined products through the strait every single day. That accounted for roughly 1/5 of everything the world produced and 20% of the entire global oil trade. The reason this massive severing hasn't crashed the global economy yet is that the system has built-in shock absorbers. We have been burning through strategic reserves, tapping into existing inventories, and relying on delayed pricing contracts to keep costs artificially steady. But those buffers are finite, and they are slowly running out. You can see the initial cracks locally. In parts of the United States, regular gasoline has already surged well past $6 a gallon. The current stability of the stock market is acting as a temporary shield. It masks the reality that the most severe raw material bottleneck on record is currently underway, and the financial impacts are only just beginning to surface. When people hear the terms supply shock, their minds immediately go to empty grocery store aisles and hoarding household goods. It's the reference point we all share from a few years ago, but crises rarely repeat themselves in exactly the same way. The sequence of events in 2020 started with a sudden global suppression of demand. Government lockdowns forced people inside, meaning the existing supply of goods suddenly had nowhere to go. Then came the massive injection of printed money. This created a rapid surge in purchasing power for people around the world. Everyone started shopping at once, draining the available supply of consumer goods overnight. The situation right now lacks both of those variables. Global baseline demand has not changed, and central banks are not issuing trillions of dollars in new stimulus checks to inflate consumer purchasing power. Expecting grocery stores to run out of stock misdiagnoses the actual threat. The economic machinery operating under the surface today is entirely different from the shutdowns of 2020. The United States buys the vast majority of its finished consumer goods from China and Asia across the Pacific, or from Europe across the Atlantic. The Persian Gulf itself only accounts for about 2 to 3% of global container volume. We are witnessing a hyper-targeted physical bottleneck. This choke point exclusively restricts and forces raw materials through a single, compromised pathway. Because the main artery is blocked, these massive tankers have to carry their cargo elsewhere. They are forced to take significantly longer, alternative routes across the ocean, which drastically increases transit time and shipping costs. The math on the resulting backlog is unforgiving. Even if the Strait of Hormuz fully reopened to normal traffic tomorrow, it would still take months of continuous, uninterrupted sailing to process the thousands of delayed ships. The danger lies in the physical restriction of the base materials required to manufacture or transport almost anything we move globally. This rerouting creates an immediate primary impact. Baseline fuel prices go up and stay up. The longer the passage remains compromised, the more expensive securing a barrel of oil becomes. That initial fuel cost bleeds directly into secondary logistics networks. Anything tied to the price of fuel, from commercial airline tickets to the diesel required to move domestic freight trucks, absorbs that extra expense. But the cascade hits a hidden victim: agriculture. This chart breaks down the global export market, showing the Persian Gulf controls roughly 1/3 of the global fertilizer trade. A strict chemical dependency links energy to agriculture. Modern fertilizer requires natural gas as a base ingredient. This creates a compounding equation for farmers. When global shipping costs surge, at the exact same time the natural gas needed to synthesize fertilizer becomes harder to get, the total price of fertilizer spikes. From there, the final step of the cascade is locked in. More expensive fertilizer means it costs more money to cultivate an acre of crops. That added expense is passed down the supply chain until everyday food becomes noticeably more expensive at the register. This slow-motion domino effect methodically inflates the cost of living across the board. Eventually, it pushes nations that cannot absorb these compounding expenses into a recession.